Hey, what's up, guys? It's Tyler the Tax Guy. For those of you that know me from TikTok, I'm a tax guy. I run a large tax resolution firm in downtown LA. We're tax attorneys, we're enrolled IRS agents, we're CPAs. We get tax problems done. So my supporters on TikTok have been asking me to do a YouTube channel. And I was thinking, like, what am I gonna do on YouTube that I don't already do on TikTok? And I was like, bingo. You guys asked me a lot of questions, so I'm gonna answer them here. Even the mean ones. All right, the first question of the roundup is, what if you're not self-employed, but you made tons in short-term capital gains? Okay, so you're not self-employed, that means you are employed, meaning on a W-2. So your employer takes out withholding taxes out of your check. That's how you pay taxes. On the short-term capital gains, that's ordinary income, but now you're not having withholding taken out of it. So not only do you owe taxes at the end of the year, you also are going to owe quarterly tax payments, meaning 4 times a year you're going to have to pay estimated taxes. Now, what you can do in this situation to avoid having a large tax liability at the end of the year is go into your employer HR office and fill out another W-4 to reflect the fact that you made the short-term capital gains. You do this so at the end of the year, you're not going to owe any additional taxes, and also you won't be required to make quarterly estimated tax payments. As long as you're paying withholding taxes on 100% of your income, you're not required to make quarterly estimated payments. If you receive income, any income that's not subject to withholding, you are subject to quarterly income, i.e. have your employer take out the taxes you owe on the capital gains out of your paycheck along with your normal wage taxes. Question number 2. My 13-month-old received a meaningful amount from his uncle. Congratulations. Besides a 529 plan, can I open a retirement account for him? First off, congratulations. What is a 529 plan? We should talk about this first. 529 plan is deferral for education. So this is actually a pretty good plan to plan for your children's future education, because you can contribute $75,000 as a single parent or $150,000 as a married couple filing jointly per year. That does not come off of your lifetime annual exclusion of $11.6 million. Anybody with a social security number, not an entity, can create one of these plans, and anybody with a social security number, not an entity, can receive these plans. It just has to be used for qualified educational expenses. Money can be taken out of this plan at any time. However, it will receive a 10% tax penalty if it's not used for qualified educational expenses. What is a qualified educational expense? Well, that would be tuition, fees for going to class, books required to go to class, however, not room and board. See, so it can be kind of finicky, and you may want to consult the instructions of Form 8863. So the next part of the question was, can you save for your child's eventual retirement as well? The answer is yes. How can you do that? You can do that with a custodial IRA or custodial Roth IRA and start saving for your child's eventual retirement now. The great thing about this is you're investing the money when the child is very young, so they have a head start, a real serious head start on their retirement. Legally, when the child turns into an adult at 18, it becomes their account and their money, and they get to make their decisions at that point. So if you don't trust your teenager, maybe it's not a great thing for them. It's better, the education fund or the IRA. Well, first of all, you'd have it even to make sense, it'd have to be a Roth IRA so that you can in fact take out contributions before you're 59 and a half, unless you really do care about your child's retirement and not their education. But if you don't know what your child wants to do and you don't have any idea on how much that educational expense is going to be, the Roth IRA might be a better way to go, because with the 529 plan, you can only use that money for qualified educational expenses. So if you don't know how much you're going to spend on that education, it might be a better idea to go with the Roth. If you want to look out for your child's education and retirement, you could do both. Question number 3. Pablo Escobar makes a lot of sense. Not strictly a question, but yeah, me and Pablo Escobar have rockin' hair, and that's absolutely why he made a lot of sense, I presume. Okay, next question. How can Bitcoin be decentralized but also taxed by the IRS? Interesting. I guess this is more of a philosophical question because the IRS, even though Bitcoin, they call it a currency, but the IRS treats cryptocurrencies, all of them, as capital property. So it's like a stock if you buy it or sell it, and not a currency if you were trading on the Forex. They're treated in different sections of the tax code. The real answer to the question is the IRS has stated that they will tax you on worldwide income if you're an American citizen. So because you made income on it, you owe taxes on it. That's really the short answer. It really doesn't matter if it's decentralized or not. The IRS says you owe money on it because you made money on it and you're an American citizen. Question, bro, I'm a teller. This is Cap. Again, not a question. I won't penalize you for that. So this was interesting because it started a whole conversation. The original question was whether or not you could take a sketchy check and have it turned into a cashier's check at the issuing bank. And we have tellers back and forth fighting about whether or not you can or not. My solution to this problem is ask for the manager. Next question, how do I file sports betting gains? Good question. In 2018, federally, the IRS decided they want to tax your sports gains, whether or not it's legal or illegal gambling. So here's what you need to do. As previously stated by the IRS, they want to tax all your income, illegal or legal. So now they're taxing your sports betting. IRS counts all income gained from any type of gambling source as ordinary income. So it's regular income added to your taxable income at the end of the year. Yes, you have to make quarterly estimated tax payments on it. So the next question is, well, hey, I lost a lot more money than I made, so can I write that off? The answer is yes, you can write off your gambling losses to the extent of your winnings. If you are a professional gambler and you can prove this 3 out of 5 years, you can actually gamble and deduct everything as a business expense. But you have to prove that you were profitable 3 out of 5 years. Question, do most tax audits occur for those in poverty? So a lot of tax audits occur for those in poverty, but not most. Actually, most audits occur for the super rich, those Americans bringing in $500,000 a year or more. However, by a thin margin, the second largest group audited is those who show zero on their income for tax returns. This is because the IRS says if you're saying that you make a lot of money, we should check you out. Or if you're saying you made no money, they probably think that's not true, or you're cheating the system somehow and they'll check you out. The least likely group to get audited is actually the middle class. The reason for that is because IRS assumes you're on a W-2, you're a small income worker, you're probably playing by the rules. If you're showing no income, it's a good chance you're not. And if you're making a lot of money, there's a good chance you probably owe more taxes than you paid. Remember, it is random, but the IRS generally wants to audit people that they either think they can get more money from or they think are cheating the system. So as long as you're playing by the rules, you have nothing to worry about generally. Specifically for low-income households, the IRS always wants to audit people who take the earned income credit because they assume that you're probably messing it up. Okay. It looks like you have an interesting character backstory. Wow. Thank you. I do. And maybe you'll find out about it if you stay tuned. Next question. Bro, are you okay? Let me check. I am okay. We're grinding out here. It's awesome. It's a new year, new money on the board. That's what's up. Okay, question. Would it be better to have a holding company to hold assets for capital gains? Kind of a generalized question. You have to think of what your goal is here. If you're trying to pay less in taxes, it's not going to help you. If it was an LLC, they're going to flow through to you anyway. If it's a corporation, it's going to owe taxes on that. And whenever you take distributions, you're going to owe taxes on that as well. If you have liability you're trying to protect against, or if you have a serious investment operation that you can deduct business expenses from, I'm sure those are viable reasons to open up an entity. Otherwise, if you're just trying to hold assets to for capital gains, which you're going to have to pay anyway, I say you're incurring a state fee of about $1,000 a year for no reason. Question: can the IRS take your Bitcoin? Well, this is unlikely, not because the Bitcoin's a cryptocurrency, but because the IRS considers it property. And the IRS can take your property, but it's unlikely. They're much more likely just to take the cash straight out of your bank account. So what the IRS is much more likely to do in this scenario is wait until you trade those Bitcoins into cash and then raid that account before you have access to it. In my professional career, rarely have I seen the IRS actually seize physical property. The states do it all the time, but the IRS they have to go through the Department of Justice, and they would much rather just seize your cash assets at the bank because they don't have to go through any department to get it done. They can just do it right then and there. Is there a moral of the story? Well, certainly pay your taxes, okay? Don't pay any more than you have to, but pay every bit that you do. All right, guys, that was my weekly roundup. Tyler the Tax Guy's TikTok questions answered. So come back next week and we'll do it again. Like and subscribe.